Good evening, everybody. My name is Patrick Fisher. I'm the Executive Director of Erie Arts and Culture. I want to thank you for joining us this Tuesday evening for the next installment of the Pro Network. The Pro Network is a suite of professional development resources and opportunities hosted by Erie Arts and Culture, thanks to funding support from the National Endowments for the Arts. This evening, we are joined by David J. Herbe Jr., who is a CPA with Schaefer Knight Minnow and Company. And his presentation is titled Filing Taxes for Freelance Creatives, which is a very relevant topic for any of you who receive 1099s for your work as artists or independent creatives. A few housekeeping rules. Please keep yourself muted if you are not speaking, just so that we can cut back on feedback. However, if you do have a question, please feel free to unmute yourself and ask your question to David. He does want this to be a conversation this evening, and he does recognize that things like finances can sometimes be pretty dense or heavy topics. This is being broadcasted on Facebook Live, so please be mindful of that as well. A little bit of information about David. He grew up in Erie, Pennsylvania. After graduating from McDowell High School in 2008, he went on to attend Bowling Green State University in Bowling Green, Ohio. There he obtained his undergrad degree in accounting. He also obtained a Master's of Accounting degree specializing in taxation from Bowling Green. Upon graduating from BGSU, David started his career in Columbus, Ohio, where he worked for 7 years before returning home to Erie, Pennsylvania. He now works as a tax manager at Schaefer Knight Minnow and Company, and he joins us this evening for this presentation. David, thanks for joining us.
Hey, no problem, Patrick. Thanks for having me. Thanks to everybody, Erie Arts and Culture. I'm happy to, take some time out of my evening to help you guys out with some taxes. I know it's not always the easiest subject matter. So hopefully today I can help at least teach you a few things to make the filing season a little smoother for you. And then, we can kind of go from there. So to kick things off here, really, there's a few things we're going to try to accomplish today. First, we want to basically go through how to properly file your income tax returns. And this is kind of important because a lot of the people on the call, you get a 1099 for the income you've received, but there isn't always the appropriate tax either withheld like it would be if you were an employee of a company. So it's a little bit trickier in filing your return versus just a typical W-2. The next thing we want to do is kind of look at some of the deductions that you're eligible for as a sole proprietor, and basically we'll go over what a sole proprietor is as well. We also want to kind of give some tips on how to keep your books and records accurate. This is important because you want to make sure you don't miss out on any deductions that you potentially could take on items that you expense throughout the year. So it's important to kind of keep a record of what you've spent and what you've received so that you can, when you file your return at the end of the year, you have your numbers right in front of you. And then one other thing is, depending upon the amount of income you've earned, there could be estimated tax payments that you need to make to the IRS. I'm sure some of you have either found that out the hard way or just know that already. So I'll kind of go through what you need to kind of keep an eye out for and what you can do to make sure those are paid timely. And then, the most important thing is just answering any questions you have. So like Patrick said, if you have questions, just jump right in. It doesn't need to be your typical lecture PowerPoint. It can be open-end discussion. I'm open for anything. So, okay, so filing your taxes. There's a lot of different entity types that you can set up and file with. And the ones we're going to focus on mostly is a sole proprietorship or single member LLC. And what that means is you basically file your information on your Form 1040, your individual income tax return. So when you get your 1099, you would report it on a Form Schedule C. And we'll go through what a Schedule C is and kind of how to fill it out. For some of you who maybe it's your first year receiving 1099, or it's just a refresher to kind of show you maybe to do a little more efficiency than you've done in the past. A couple other entity types, there's an S corporation, a C corporation, and a partnership. So depending upon how complicated your situation is, there are different entity types which require separate filing than just your individual return. But I'm not going to dive too deep into those. Those are just kind of a different path. And as your business becomes more complicated, sometimes it makes sense to start a company, a corporation, or a partnership. But for now, in this presentation, we're going to focus on the sole proprietorship and filing on your individual return only. So as a freelance creative, like I said, anytime you receive income greater than $600 from a specific vendor or customer, usually you're going to receive a 1099. It used to be a miscellaneous, but for 2020, the IRS actually changed their type of 1099 that they provide for non-employee compensation, meaning it's your form, and some of you have probably already received it. It's actually 1099 NEC, not a miscellaneous. So it's not going to change how you actually file your return. It's just something the IRS does to change their form and make it easier for them to follow when all those 1099s are filed. But if you only earn like $300 from a specific customer, then you don't need to file 1099. However, you should technically still pick that income up on your return. Like I said, the 1099 is recorded on your Schedule C, and we kind of went over in the previous year, the 1099 miscellaneous was what you received, but this year it should be a 1099 NEC. So keep an eye out for that if you have not received it yet. So this is Form Schedule C, and this is where you report that 1099 income. So once you receive your 1099 form, it'll all be filled out on this form here. You would name a proprietor. Usually, if you don't have a business name, it's just your individual name with your social security number. However, if you do have a business name, it would go on line C here. Some businesses have an EIN, some don't. It's really your preference. I would recommend if your business starts to get complicated and starts to really ramp up, it might make sense to create a LLC, a limited liability company. And it won't change your tax reporting. It's called a single member LLC. It's a pretty easy filing with the state of Pennsylvania. And you would essentially create a separation of legal liability from your business, from your other personal assets. And that's something maybe you can think about down the road. But I just want to point it out that it is something that people do create, and it's more for a legal purpose than it is from an accounting or a tax filing purpose. So if you do have an EIN or an LLC, this is where the business name would go. And most of the time your business address is your home, unless you have a studio or a place where you keep your art, or a separate office that you run things out of. So this is kind of what the overall Schedule C form looks like, and this is what should be included in your return if you do receive that 1099 form that I mentioned before. And we're going to continue to go through here now and just kind of go through line by line on what some of these boxes mean. Should you be filling it out? Are you filling it out correctly? Are you including everything you should? So hopefully this helps answer some questions you guys have and makes your filing a little smoother. And like I said, jump in here if I say something that you're not sure or don't really understand. I'm happy to help explain. So the first thing, and this is kind of an important thing to answer, on line F for Schedule C, there's this thing called an accounting method. You're either in a cash basis taxpayer or an accrual basis taxpayer. And really the difference is cash means what cash did you actually exchange hands during the year. So did you actually pay somebody for supplies? and did they actually pay you for that piece of artwork? If they did, then you need to recognize it. But if they haven't actually paid you, or you haven't actually paid for any expenses, then really that gets pushed off until that cash exchange hands. And then for an accrual basis taxpayer, what that really means is it's when you incur it. So if you're, doing a painting or sculpture or another piece of art that you're selling, and you technically haven't sold it, meaning the property hasn't gone into the hands of the customer and they haven't paid you yet, but you have the agreement in place, you would really recognize it for that year, because you really did. You built a piece of artwork, or you created the painting or the drawing, and you've agreed to the sale. You just haven't really exchanged the cash yet. So it's something you want to think about and do. Now, the cash method, you have to have under $26 million of gross receipts. So I would think most people on this call probably qualify for the cash method, which is the simpler method, which is what I would recommend if you do have under that threshold. But if you are over that $26 million of income on a yearly basis, then you have to use the accrual method of accounting. But most Schedule C filers and 1099 receivers, they're under that 26 million, which basically means you can choose the cash method of accounting. Whoops. So that's kind of just a brief overview. Hopefully that made sense to everybody. So going further down the Schedule C, once you enter your 1099, and if you're using TurboTax or H&R Block or a simple software like that, it's pretty intuitive, and they pull the information for you to the right line. So I wouldn't worry about having to worry about handwriting some of this in. Now, if you do your own, I'd pay a little bit closer attention, but most of these softwares are pretty nice, where you just stick in the 1099 information and they pull it to all the right forms for you. But when you do enter your 1099 information, it should show up in this box 1 here. And that's for all of your gross receipts. So even if you didn't get a 1099 and you sold something for $400 and another thing for $300, and it adds up to a couple of thousand, it should still be reported here under box 1. And that goes back to the importance of keeping accurate books and records so that you make sure you're capturing everything on your return. And then if you keep going down this line, you can see, if you give any discounts, or if anybody returned a product for some reason, you would offset it with this line too. So if you sold something for $100, but you gave a $20 discount, you would have a negative $20 on this line too, which would make your gross receipts $80. And then as a freelance creative and an artist in general, sometimes you're required, or it's necessary, to track inventory, meaning as you start to, have multiple drawings or paintings or sculptures or any other type of artwork that you're selling, as you start to accumulate that product, and it's not necessarily being sold to the end customer yet, you want to keep it in your inventory. And then when you actually make that sale, that's when it would actually be taken out of your inventory and expensed, and reducing your income, thus paying less tax. So when you're keeping track of your inventory, your product, it's important to do that. And then it's also important to make sure you expense it when you actually sell it, so that you can pick up that expense on your return. In this part 3, it's actually the second page of the Schedule C. It's at the top of the page. This is where you would fill out that information. If you've tracked it in the past, this inventory would match the end of last year's tax return. And then anything you've purchased to help create that art project or product that you're selling, that would basically go under this line 36. If you're paying anybody to assist you in the process, whether it's an administrative assistant or another artist who works for you, and it's directly related to that product, you could simply list it under line 37 here. You know, I mean, most of the time, if you're creating a piece of artwork and you're selling it pretty rapidly, you're not accumulating a lot of product. It doesn't really make sense to keep track of inventory. You would actually, I'll go back to, you'd actually just throw it up into these expenses here. So if you bought supplies or different items that went into the creation of that product, you could just list it here. You don't need to actually track the inventory. It's only when you're kind of creating a lot of product at one time, it helps you keep track of how many you've sold versus how many you still have on hand. So it's just, as your business starts to get more complex, there's more reporting requirements. So it's just something to keep in mind as you maybe your business progresses over time. So here's one of the bigger items to keep an eye out for is recording your expenses. And I was kind of starting to go into this, for all your everyday expenses, you want to make sure you're tracking it properly. Because if you don't, and you're at the end of the year and you're trying to scramble to remember, oh, what did I pay for in January? And it's now December. It's very hard to do that. And you want to make sure you pick up all expenses that you can. And there's lots and lots of expenses that actually qualify for deductions. Maybe some things you don't necessarily think of. And here's a quick list of items that you can write off against the income that you've earned. Office supplies, obviously your supplies that go into the creation of your artwork is also very important. If you advertise, that's also a deductible expense. Any insurance that you have to take out relating to your business is deductible. If you take out a line of credit or you have a credit card or anything like that, the interest paid on that is deductible. Anything you pay like a guy like me to prepare your return or an attorney to set up a entity, an LLC, those are deductible expenses. Any like licensing that you need to maybe sell your artwork would be deductible. If you're renting a studio or office space or anything like that. And then obviously any art equipment, machinery, supplies, anything like that that's directly related to the sale of that product, you can deduct. And then there's a big one too. If you're traveling a lot, and I know with the pandemic that's kind of been shut down, but if you're traveling a lot, you want to make sure you keep track of your business miles that you're driving to and from, an art show or a conference or customers' house or anything like that. You want to make sure you keep track of that and that travel.
David, I have a question.
Yeah.
You mentioned that if you rent a studio space, you can record that as an expense.
Correct.
What if you have a designated studio space within your home? So say you have a 3-bedroom home and one of the bedrooms is dedicated as a studio space or perhaps a garage. Are you able to determine the square footage of that dedicated space and figure out either your mortgage or your rent and include that as a recorded expense?
Yeah. And I got a slide here coming up. I'm going to go into detail on that and just kind of go over an example of how to report that and what items you should be including in that calculation, because I know, it's common for artists to have a studio in home. And as long as that space is designated area for that use only, it will qualify. So I'll go into a little more detail here in a couple slides, but hopefully that helped answer the initial question.
Yeah, thank you.
Yep. So back to the Schedule C. This is the second part of the first page of the form, where you would record your various expenses that I kind of mentioned here. A couple other things to kind of keep an eye out for, if you're paying somebody to help you as an assistant, maybe it's contract labor, maybe you have payroll, if that would also be deducted. Here, line 26 is utilities, or I'm sorry, wages, and there's also contract labor, depending upon what type. One other thing to keep an eye out for is if you do need to buy some, heavy duty equipment, or maybe you're renovating your studio, you want to keep track of those expenses, because you might be required to actually depreciate them, which means you might actually have to take the expense of those over a longer period of time versus expensing it all in the year you actually pay the cost. So for example, if you buy a piece of equipment that helps you create a sculpture or something like that, and it costs you maybe $5,000 or $6,000, you're probably going to be required to depreciate that over 5 years. So that's just something you want to make sure you keep an eye out for, and you're not just writing it off in the first year. Now, the IRS currently has some pretty advantageous rules when it comes to depreciation. So anything that has an asset life under 15 years, and generally what that means is anything that is machinery, equipment, small improvements, those would qualify for what we call bonus depreciation, meaning you can write it all off in 1 year. However, though, let's say you're putting an addition on your house to create an art studio, anything that's a structural or outside component where, if you put a whole new room on, that whole outside of the room, that would basically be a 39-year property, meaning you actually have to depreciate it over a long life, and you can't always expense it. But those are probably rare situations. Probably doesn't apply to everybody, but just something to point out in case you do, especially with the pandemic. Before things are a little more interactive, a lot of people now are at home, and maybe it makes sense here in a year to maybe add on to the house to create your art studio, or maybe your business is taking off and you want to build a office space or studio space. That's when depreciation will come into play. That's something you want to make sure you keep track of. Let me go back. So what Patrick was alluding to here is, if you can see this line 30 here, expenses for business use of your home, these actually go on a separate form 8829, unless you use this simplified method. But I'll go into those methods and what it entails to claim that detail and that expense. So the home office deduction, really what it is if you have a designated room, like Patrick was saying, a 3-bedroom house or condo or apartment, and you use one of those bedrooms specifically as a studio or office space, as long as it is 100% used for business, you can essentially use that as a home office deduction. So there's these 2 tests that you have to meet. The first is it has to be regular and exclusive use of space in your home for business only. Like I was saying, if you have that 1 bedroom that's designated for that use, that's 100% fine. Or if you have your garage and you're holding, some art in there as inventory, that would qualify. That space in your garage would qualify for the home office deduction. And this also has to be your principal place of business. So if you actually have a principal place or a studio separate from your home, which would technically be considered your principal place of business, and then you also have maybe a bedroom back home that you do some work into, technically you can't claim that home office deduction, because you do have that permanent place or principal place of business, that studio. So I haven't seen it challenged a lot. You can probably make a case that studio too is also, or the bedroom that you use is considered a principal place of your business. So I would say if you're using it exclusively and regularly, that usually meets the test, and you can claim the home office deduction. So what happens with this home office deduction is you can basically choose two methods. You can choose the simplified method, which, let's just say you have a 1,200 square foot house and 300 square feet you use for your studio space. That percentage you would take of your Schedule C income, which you would then reduce your net income by that amount. There's also a direct method, the regular method, which it takes a little bit more effort, I guess, to accumulate those expenses to calculate it. But essentially, you can write off a portion of the utilities you pay for your house, real estate taxes, mortgage interest, you know, like your electric bill. If you can find what you pay, let's say your electric bill was, I don't know, $50 a month, $50 a month, and you did it for 12 months. So if you use 300 square feet of your 1,200 square foot house, you would take a percentage of that overall electric bill. You know, let's just say it's $500. You would get that percentage of that allocated to your home office deduction. So most of the time, the regular method will produce a larger reduction. However, some people don't always want to go through the trouble to track down all those expenses that you've incurred for, you know, your mortgage interest, your real estate taxes, your utilities, everything that you pay for your home, to allocate it to that portion of the home office space. So the simplified method does make sense sometimes. And there's also times where maybe your business didn't make money. And if it didn't make money, then unfortunately you can't claim any additional deduction to create a loss. And there's also situations where maybe you make $400 net profit, and your home office deduction would actually produce $1,000 deduction. You can only claim 400 of that in the current year to net your net income to zero. So it's a very helpful tool and something people don't always think of. But if you do have that regular space used in your house, you definitely want to make sure you accumulate those expenses, those utilities, those real estate taxes, those mortgage insurance or interest payments that you pay on your home, and make sure that that gets allocated. Like I said, TurboTax, H&R Block, these softwares that a lot of people use when they self-prepare their return, they calculate a lot of this for you. So you're not going to have to do this stuff by hand. But you know, it always helps to have somebody you can trust, like an accountant, to double check your work or reassure you that this expense actually qualifies. And then something else, like I was saying earlier, was vehicle expenses. You want to keep track of these if you're going to a lot of different clients or a lot of different businesses. So you can either take one or the other. It's either miles driven, your business miles, or the actual vehicle expenses. And by that, I mean, what gas did you pay? Did you have to pay for repairs? You know, did you get new tires, etc.? Now, you want to make sure you're not deducting a lot of any personal auto expenses. So if you are going to take the actual vehicle expense detail, you need to make sure you separate the business trips versus your personal. So, you know, if you're going to the mall and you fill up your gas tank, that doesn't really qualify for the actual vehicle expense deduction. But if you're filling up your gas tank to go to a customer, then that would qualify. So most of the time, most of my clients, we take the miles driven. It's more accurate. Majority of the time you get a bigger deduction. And sometimes it's hard to keep track of the personal versus business miles. It's tough. So I usually recommend the miles driven. And that for 2020, the miles driven rate was 57 cents, basically 58 cents per mile of business miles driven. So that'd be an additional deduction that would be shared. And here is the last part of the Schedule C, this part 4, where you would basically disclose your vehicle information. There's some questions you would need to answer, whether it was available for personal use off duty. Did you have another person who used it for personal use? And do you have like support to support your mileage? So if you are going to claim your business mileage, it's important that you keep a log of that so that you can make sure if the IRS were to ever question you, you have support for that. And I just want to reiterate again the importance of keeping clean books and records. You know, I see it a lot where, you know, a lot of people, and it's no fault to anybody. I mean, I'm in this space, this accounting space where, you know, it's on my mind to keep clean books and records, but not everybody thinks like me. So it's just something you want to make sure you do, because you get 10 months into the year and you're like, oh, well, I haven't kept track of anything. And you're trying to go back to remember what you did in January, February, March. You might not have proof of everything, and you miss some expenses or income that should technically be on your return that isn't, especially the expense part. You know, you don't want to make sure you're not paying taxes on income that could have been offset with expenses. So I always recommend to open up a separate bank account for your business, even if it's in your name and it's personal and you're just kind of doing it on the side. It just keeps everything clean. Or if you have a credit card, you want to take out a business credit card to keep track of those expenses. I just recommend that. It keeps everything clean. You're not running personal stuff through it. And then if you can, pay everything through a check or an EFT, electronic funds transfer, so you have a proof or a receipt of payment. Sometimes with cash, you pay something cash and you don't have a receipt, and then you forget to claim it. So it's important, and it helps keep and file your return accurately. And then, you know, depending upon how complicated your business has become and is getting, you know, there's QuickBooks that you can purchase to keep track of your books and records, create a balance sheet, create an income statement, create you know, just a cash flow and a trial balance. And then, you know, even Microsoft Excel or Google Sheets, if you just kind of keep track of your expenses and your income over the year. You know, bank records also help, bank statements for the year, those help. So just kind of, I would just establish a method of record keeping so that you're consistent, and then your return's accurate and you have proof to the numbers that you're supplying to the IRS. So this is kind of a bigger one. And it's something that people don't always comprehend or don't always do, and it's paying quarterly estimated taxes. So as an independent contractor, it's important that you pay these timely if required to. And basically the requirement that you have to pay quarterly estimates is if you owed greater than $1,000 of tax, let's say you file your 2020 return and your tax bill is $1,200. You're going to be required to make quarterly estimates. And it's important to make sure you pay those, because the IRS will subject you to underpayment penalty. And depending upon how high your tax bill is and how late you are with your estimates, you know, those penalties and interest can accrue and become rather large. And it's an expense you can avoid paying. So as a sole proprietor, generally the revenue you earn is not withheld from. So you have no withholding paid in the IRS like a W-2 employee would. So there's these 4 dates that are important: April 15th, June 15th, September 15th, and January 15th. And those are important to make sure that your quarterly estimates are paid on a timely basis. And these payments, they actually go onto a Form 1040 ES, which I'll show you an example here coming up. And like I mentioned, if you actually owe less than $1,000, you don't actually have to pay any of these. Even if you owe less than 1,000 and next year you owe 2,000, you're not going to get hit with any underpayment penalty or anything like that. But if you do owe over $1,000, you definitely want to make sure that you're filing and paying your 1040 estimates. And this also goes for states too. Pennsylvania, for instance, they require it as well. So if you do have state payment in Pennsylvania, it's about 3% tax rate. You'll want to make sure that you pay those in as well. Their penalties aren't as harsh. So if you do miss the state ones, that's not as big a deal. But the federal, you definitely want to make sure you pay those in. And here's just an example. This would be if you're paying your second quarter. It was due January 15, 2020. It'd have your name and address and the amount, and then you'd mail a check in. You can also pay these online, IRS, through EFT. So if you don't write checks or don't want to write checks, you can pay it directly online through their website, www.irs.gov/etpay. And then this is just kind of an example to go over on how you can avoid that underpayment penalty if you do need to pay those quarterly estimates. So Joe Smith, he's a business owner who owed $5,000 in taxes for his 2019 tax return. He's getting ready to file his 2020 filings. And he basically is required to pay estimated tax because he owes $5,000, or he owed $5,000 in 2019. So the IRS has a rule, and they basically say you can safe harbor yourself. So it's hard to predict what the future looks like. So when you file your return, let's say you file this year for 2020, or next week, and you owed $5,000. When you're calculating your estimates for 2021, you can safe harbor yourself, meaning you can pay in 100% of what your 2020 taxes so that you'll meet that threshold. Now, it could be a double-edged sword, meaning if you pay in that $5,000 and in 2021 you only owed $3,000, you would have paid a little bit extra in, but you would get that money refunded. And depending upon how much you overpay, you get some interest back. But you can also do it quarter by quarter and calculate your estimates for 2021 on a quarter by quarter basis. You just need to make sure you have at least 90% of your tax paid in before you file your return. So that's just something to keep in mind. For our clients, we'll do a quick calculation and just say, hey, look, based on what you're expecting for the next year, here's what you would owe. It's only $1,000 different than what your prior year was. You should probably pay the $5,000 just to make sure you don't pay any penalty or interest. But it's whatever everybody's comfortable with. So just a quick pointer, make sure you're in line with the IRS. And then another tax that comes into play for some sole proprietors is the self-employment tax. And how this usually works is if you're a W-2 employee, you would already have paid your self-employment taxes, Social Security and Medicare, through your W-2 withholdings. Now, since you're not, you receive a 1099, you receive gross wages, you actually don't pay anything in until you file your return for the Social Security and Medicare tax. If you have any income, net income that is, not gross income, net income in excess of $400, you're going to be subject to this tax. Now, it's currently, if you combine it, the Medicare and Social Security, it's 15.3% of your net income. But the IRS gives you a break, and they basically say, well, you only technically owe half of that. So we're going to reduce half of that bill against your adjusted gross income. So really, you're only paying 7.65% of that tax. So it actually evens out to what it would be as if you were a W-2 employee. It's just not being done for you. So when you are calculating your estimated tax, it's important to keep this in mind as well, that you might have some self-employment taxes that you owe. So just something, another thing to add to the list to keep track of. And a lot of these tax softwares do this for you. When you prepare your return, they'll give you a statement. They'll tell you, hey, here's how much we're projecting you would owe. And it includes the self-employment tax. So it's, again, nothing that you're going to need to do and calculate by hand. If you use TurboTax and H&R Block and some of these self-preparing softwares, but it is something I just wanted to at least point out so you can try to understand as you go through your tax filing process. And this is the form that kicks out here. So your name, and this is where your net income is going to flow through, and it's going to calculate your self-employment tax. So if you are subject to SE tax, this form will actually print with your return. And then just a couple of other items that I wanted to point out. Depending upon what type of business you have, how successful it's been, as you continue to grow and you start, you're like, wow, I'm making some decent revenue. I should maybe start to think about, should I invest it in a retirement account or somewhere where it's earning some money and it's not just sitting in my bank account. There are some self-employed retirement plans that actually reduce your tax bill and allow you to save for retirement. So I would definitely think if you got some extra cash, let's say you had a good year or a couple good years in a row and you're sitting on some extra funds and you think you want to open a SEP or a self-employed retirement plan, I would contact a financial advisor. They can help you get something set up. I know like PNC Bank has that ability, Northwest, a lot of banks around here. They have that ability to help you and assist you with that. So if that's something that interests you, I would contact a financial or bank advisor to help you get that set up and enrolled. And then for your health insurance, if you're a self-employed individual and your only health insurance that you pay personally the premiums, it qualifies for a self-employed health insurance deduction, which will actually help reduce your gross income, which will allow you to pay less tax. Obviously, it's still cash out of your pocket. So, but it is something that we see missed for Schedule C preparers. So if you're not on a retirement or a health insurance plan through a W-2 or another employer and you pay for it yourself out of your own pocket through your own business, then it is something that you can qualify for and deduct on your return. So that's kind of all I got. I just wanted to hit on some of the more important things that I see on a daily basis, especially for self-employed filers and sole proprietors. And I just wanted to kind of overview what it looks like filing Schedule C, kind of what it looks like to make sure you get your estimated taxes paid, the self-employment tax that comes into play, and then just some of the expenses that you're eligible for that maybe you've missed in the past that you should be starting to deduct, and start thinking about the home office deduction. So I'm open for questions if anybody has any, and go for it.
Hi, I'm Deb Bahanian. I have a question.
Hi, Deb.
Hi. Hey, so the health insurance that you pay through Medicare, is that deductible?
Yeah, I believe so. Those Medicare premiums.
Uh-huh.
Yep.
So could you go over that one more time, how we do that?
Yeah, so you just keep a tally of what you're paying in Medicare, your insurance premiums. So let's say you paid $5,000, and it's related to your own health insurance. It would be self-employed health insurance deduction.
Well, I got a question. So even if you are not set up as formal legal sole proprietorship, you still get taxed as correct?
Antonio, it's hard to hear you. Is your mic pointed towards you?
Yes.
That's better.
Can you hear me now?
Yeah, it's better.
All right. So if you're not set up as a full legal sole proprietorship, you're still taxed like you are, correct?
Yeah, like you don't have to have like a legal entity. So if it's just under your like Antonio's business, if it's under your name and you earn the income and it's under your social security number, yeah, you still file Schedule C. You don't have to have like a legal entity set up. No. Like I think sometimes the sole proprietor, it sounds a lot more formal than it is. But if I went down the street and sold you 2 hot dogs for $1,000, I would have to report that on my tax return. I don't have like a business set up or anything, but yeah.
Okay. Gotcha.
David?
Yeah.
I sent you 3 texts in the chat, and my questions may not be relevant to the rest of the attendees. And if you want to read those, and you can reply to the email address I gave you.
Sure.
Thank you.
I can do that. Yep, no problem.
Thank you.
I just wanted to make a shout out for that. There's a great website if you want to do your taxes online and you're under a certain income. You can do your taxes free with TurboTax or H&R Block. It's kind of a long story, but basically the TurboTax and H&R Block have an agreement with the federal government that they will provide free online tax preparation services for people under a certain income. However, those companies make it really, really hard to access those services. So if you go to TurboTax website and you say, oh, and they'll say, oh, you can do your taxes for free. And then they'll ask you, are you self-employed? And you say, yes. And they say, oh, then you need to purchase this thing from TurboTax. And that's a lie. It's a very crude URL, but thanks to Hassan Minaj, go to turbotaxsuccess.com. It really works. You're under a certain income, that is a portal to the actual free online tax services. It works.
Do you know what that figure is, Kelly?
Do
you know what that figure is? The max of income?
The maxable for an IRA?
No. For
I don't know, but it's pretty high. I mean, it's like I don't know, but it's something like under $60,000 a year, $40,000 a year, or something like that.
Oh,
yeah.
Good. All right then. Thank you.
Kelly, could you send us a link to that?
I just put it in the chat.
Oh, I didn't see that. Where's the chat?
But that'll also walk you through it. So yeah.
Okay. All right, great. Thank you.
I know Chris had a question that he typed out in the chat function as well. Chris, if you're still on, you want to unmute yourself and ask it?
Yeah, sure. Actually, David, I have 2 questions for you. First of all, like I have not filed my quarterly estimated taxes yet. Am I now being penalized from, like since January 1st or whatever?
Yeah, potentially. It probably depends on what your tax situation looks like. Because if you actually file your 2020 return, and let's just say for some instance you don't actually owe any tax, you're not going to get hit with any underpayment penalty because you technically would have paid 90% in because you owed 0. So I don't know what your specific situation is, but if you do owe tax, you're going to probably get hit with some penalty. I'm not sure exactly how hefty, but it'll actually be calculated on, it's called Form 2220 underpayment penalty calculation.
Okay. And does that penalty like increase every day?
Yeah, usually it's on a per day basis.
Okay. And then my second question is like, say like I buy new computer equipment and I'm guessing that like there's a depreciation, maybe like 5 years or something.
Yeah, usually. I mean, it depends. So if you bought, let's say you bought a laptop and it was $1,000, it's actually, you can actually write that off. So the IRS has a de minimis rule, and they basically say anything under $2,500, you can expense immediately. So if it's equipment or supplies or anything that's under that threshold, you don't need to depreciate it. But if you spend something, a piece of equipment or supplies that's over that, that's when depreciation will actually come into play.
Okay, then the second part of that question is like, so say like I upgrade my computer like every 2 years. So it's like, less than a 5-year depreciation.
I'm sorry, could you repeat that?
Yeah, so say I like, I continually upgrade my equipment. It's over $2,500. Like, how does that work then? Like if I upgrade it, every 1 to 2 years.
No, you can. No, you can still write that off. It doesn't like accumulate.
Okay.
Sorry, guys, I'm having issues with my camera for some reason. So sorry, I don't think you guys can see me. But
I think what Chris was asking, if I understood correctly, is if a standard depreciation rate is, let's say, 5 years,
yeah,
but he's replacing every 1 to 2 years, does he just instantly write the full amount off, or can he only write a portion of it off, even though it's not going to be depreciated over that 5-year period because he's replacing it every 1 to 2 years?
No, he can write it all off. Like he does not need to cap. That's what I guess what I'm trying to say is if you have an expense for under $2,500, so say you bought a computer every year for $1,000, you'd be able to expense that in the first year. You don't need to depreciate that.
There was one.
Okay, thanks.
There was one question that was directed to me, and I suspect this is the one that you were saying could be answered via email, but I do think it's an interesting question that others in the group may benefit from. Ruth, do you want to go ahead and ask that question about your Steinway?
Sure. Okay. I was told by tax preparers in the past, I purchased my piano in 2014. And the woman that was doing my taxes insisted that it should be depreciated. I bought it in 2014, and in doing my taxes in 15, it had to be depreciated. And every year thereafter, and I kept insisting to her that I was told by the seller, Steinway and Sons, that Steinways appreciate, and significantly so as soon as you take them out of the seller's studio. So how do I recognize all that? Because I purchased it as an investment because of its increasing value over time. It was like investing money in a mutual fund.
Right. Yeah.
I put it into collateral. So
right.
do those two mutually contradict? Writing it off, declaring its depreciated value in the same breath as acknowledging that it has appreciated in value over time.
Yeah, so they don't really, it's kind of a different look. So that appreciation in value, you'll actually gain that when you sell it. So,
right.
Yeah, so 20 years down the road, when you sell the property or the asset, that's when you'll recognize that increase in value. The depreciation, that's what the IRS basically is saying. You can, let's say you spent, I can't remember what you said exactly you spent on it, but $10,000.
I didn't tell you. I don't.
No, that's okay. You don't need me. I couldn't remember if you did.
Yeah, that's okay. But it was half the value of my house.
Right. I mean,
so yeah.
They make you actually depreciate that over the life instead of expensing it all in 1 year if it's over a certain threshold. So they're just basically requiring you to take a slower expense over the life of that asset. It doesn't really decrease or mess with the appreciation and the value of it when you go to sell it down the road.
Okay, so they're like parallel. They don't intersect. They don't.
Right.
One doesn't influence the other.
Yeah, the only thing that'll happen is,
Yeah.
let's say you sell it 10 years down the road, your cost basis, so what you originally paid for it, will actually be reduced by the depreciation because you're taking that expense on your tax return. So if you sell it for $100,000 and you originally bought it for 50 and you depreciated it at 30, really you only have $20,000 left in cost basis. So you would actually recognize a gain of $80,000 versus 50,000, if that makes sense.
Once I sell it, and if I sell it, then I have to pay capital gains.
Correct. At that
And
point.
so my capital gains are going to be higher.
Right.
So the tax system eats up my profit on the sale by depreciating it over time. I suppose that's true of anything that appreciates over time, like any antique or any.
Yeah,
That's
anything
what
like
bite you in the end by you lose your ultimate profit because
yeah,
you have to pay
but
it in taxes.
yeah, and you do get that benefit though in that tax year. So
that's true.
You get that write-off each year, which reduces your tax bill that year.
Oh, I suppose so. It might even out if I actually crunch the numbers.
Right.
Okay. All right. Okay. Yeah, I was never big on thinking like this, so I'm
Hey,
depending
that's
on you.
it.
I'm
That's
just
okay.
trusting you. That's why you're there. Okay.
Exactly.
Thank you very much. And the other questions are, you can do an email, and I've just copy pasted them into an email reply if you do want to email them.
Okay.
Tell me about them. Thank you.
Thank you.
Yeah, this has been very helpful.
Any other questions for David this evening?
Yeah. David. Okay. Can you hear me?
Yeah.
Yep.
So what are the adverse effects or interplay between having sole proprietorship, unofficial?
Antonio, I'm having trouble hearing you.
I don't know why. Can you hear me now?
Yeah.
Yep.
I don't know what's going on, man. So what are the adverse effects of having sole proprietorship or unofficial sole proprietorship being married, man? Like, does that, you itemize with your business, your the art business, but can you still claim like the 12,000 for being married too, or one or the other?
I'm still having trouble hearing you, Antonio.
So Antonio asked if you are structured as a sole proprietorship and you itemize, are you still able to but you're married, are you also able to still deduct the $12,000 write-off? Is that correct, Antonio?
Yes.
So are you talking about the standard $12,000 standard deduction?
Yeah.
So you can either itemize or you can take the standard deduction. So for a married filed joint return, your standard deduction is probably about $25,000 now with inflation. So unless you have itemized deductions, meaning medical expenses over your adjusted gross income, taxes capped at $10,000, mortgage interest, and charitable contributions greater than that $25,000, it usually makes sense to just take the standard deduction. It's one or the other. You can't itemize and take the standard.
Okay. And does everything you explained to us about practice for creative apply as well?
Antonio, could I ask you to maybe type your question in the chat function? Your mic keeps cutting out, so it's really hard to hear you. But if you type it in the chat function, I'll read it out for you.
All right.
Sorry, bud.
Yeah, I just want to make sure I answer for you.
While Antonio is typing out his question, do we have any other questions from the group this evening for David? While we are waiting for Antonio's question, okay, so Antonio says, does the info you provided also apply to book sales as well? So someone like Antonio, who's a visual artist and a literary artist, he is not just selling physical artwork that he created that's a visual medium. He's also published 2 books this year and a book a previous year. So does the itemized deductions apply similarly to, say, the sale of a book and the expense of publishing that book versus the visual art?
Yeah, so the standard deduction applies to your return in general. So even if you don't have a business, you can still qualify for the standard deduction.
I think he's specifically asking about, can he so in addition to his visual art sales, can he also itemize all the expenses associated with the publishing?
I see. Okay, you're not talking about, okay, you're talking about taking the expenses on Schedule C. So yeah, you would file a Schedule C for both your book sales and any of your other sales from your 2 separate businesses. So any revenue from your book sales can be offset by any expenses that you incurred in selling those books. Okay. Same thing with any revenue from any of your other art sales can be offset by those expenses from those art sales. And they all get combined together and are reported on your 1040. So yeah, they basically will offset. Hallelujah.
Antonio, give me a thumbs up if that answered your question.
Yes. Another one in the chat.
Okay.
Same Schedule C or different one? They have to be separated.
It should be different. If they're separate businesses, it's different. It's 2 separate Schedule Cs.
Okay. All right. Okay. Thank you.
Yeah.
If there are no other questions this evening, I want to thank David for sharing his knowledge and expertise with us. His contact information is shared on the end of his slide. I do believe that when you all received the link this afternoon for tonight's session, Jade also sent out the David slide. So feel free to contact David. I also want to encourage you all to visit our Pro Network webpage. I just typed that URL in the chat function. There you will find a wealth of resources for independent creatives in our region and community. We are trying our best to routinely post opportunities that artists are eligible to apply for, whether they are grants, residencies, fellowships, public art projects, etc. You will also see a schedule of upcoming webinars that we are hosting. On February 18th, we host the next installment of the Pro Network. We will be joined by Professor Dustin Harewood when he will be presenting on craft, content, and purpose. Dustin is a visual artist and professor of art down in Northeast Florida. Again, I want to thank you all for joining us this evening and encourage you to continue to attend these learning sessions, which have been made possible by the National Endowments for the Arts. So thanks for joining us this Thursday or Tuesday evening. And again, David, thank you for your expertise.
Yeah, no problem. Everybody have a great night. Sorry about the video.
Oh, you're fine. Have a great evening, everybody.